Welcome to another video on accounting made easy on the whiteboard. We ask you right from the beginning to subscribe to our channel, like our videos, share with your friends, and comment because we are on a journey to make accounting easy to you, whether you're a student, whether you're an entrepreneur, right? Whether you're working in the accounting profession. My name is Anthony J. Stewart of Personal Financial Solutions, and I am a certified public accountant. So, with that out of the way, let us today continue our journey with accounting. The last session we described what accounting is, and today we want to take it a step further by introducing you to the 5 major categories of accounts where all record keeping for a business will be done. However, before you can understand those accounts, you must know that the record is made from a transaction, a business transaction. So the question is, what is a business transaction? So we're going to start there. A business transaction. So a business transaction is any business activity that can be measured in the terms of money. So an activity that can be measured in money. For example, I used this example in the previous video, and I'm going to use it in this session also. Purchase of a computer. That is a business transaction because the transaction can be expressed in terms of money. Purchase of a business computer for $2,000. That's the transaction. So we are saying to you that all transactions would be entered into 5 different categories of accounts. Mind you, those categories of accounts are like we call omnibus categories, and they have small accounts under each category. But we're just going to discuss the broad categories today. But before we get into the categories, we are going to tell you examples of accounting transactions. We could have a sales transaction, sold services for cash, $20,000, or sold goods on credit, $15,000. Sales transaction. We also have purchases or purchase transaction. Purchase the computer for cash, $2,000. Purchase a motor vehicle to be used in the business on credit, $100,000. A purchase transaction. We also have receipts of money. For example, the sales transaction on credit to John Tom. John Tom paid his account. So we say our customer, John Tom, paid $5,000. Transaction receipt of cash. And we also have payment transaction. Paid installment for the motor vehicle, $1,000. Payment transaction. So these are transactions within the business that must be captured in the accounts. You must note the monetary aspect of a transaction, because businesses may have a transaction like this here, right? We had a staff meeting today. Something happened. That is not a transaction that we measured in terms of money and recorded in the accounts that we're going to tell you about right now, the 5 major categories of accounts. So the 5 major categories of accounts . One, assets. Assets represents resources owned by the business. Some of the assets we use up right away, like cash. Some assets we hold them in the business to help us to make revenue for the business, like the motor vehicle, like the building, like land. So these assets we call fixed assets, and the cash we call a current asset, short-term asset. So assets can be divided into 2 broad categories: current assets and fixed assets. Or you may see non-current assets, long-term assets. They all mean the same thing, right? On the current assets, we have other assets like cash, bank, accounts receivable, prepaid expenses, etc. We are not into the itemizing of the assets at this time. We just want you to understand the broad categories. We will do the itemizing of assets later on in another session of Accounting Made Easy on the whiteboard. So we also have another category of accounts: liabilities. Liabilities represents what you owe. Remember we said purchase of a motor vehicle for the business on credit? Well, we owe that to the car dealer. So it's a amount owed by the company. So any monies owed by the company is considered a liability. Now, the liability can also be captured in different current and non-current categories. So we also have liabilities, current liabilities, and we have long-term or non-current liabilities. Current liabilities are liabilities that must be paid within a year. Long-term liabilities are liabilities that you can pay more than a year, over a year. But interestingly, a long-term liability, like a loan to a financial institution for the motor vehicle, for example, every year, the amount that is due for the next 12 months coming becomes current liability. So the loan presentation will always be part current and part long term. And we'll discuss all those presentations when we discuss financial statements. But our task today is to identify the 5 major categories of accounts. So we are at the third category. And this category we'll call capital. Capital or owner's equity or stockholders' equity, depending upon the type of business that you have, right? So we already discussed business types and so forth. All that we will discuss the different types of businesses, right? Sole proprietorship, limited company, partnership. We'll discuss those in another session. But capital, the capital structure now, would be determined by the business type. But just to suffice, capital is what the owner put into the business. It's the owner's amount in the business, what they put in and what the business will earn over time. Capital. So just for a quick example, let's say the business starts today and the owner brought into the business or brings into the business all of the furnishing, and the furnishing costs $100,000. Well, you will have an entry where the capital will have an amount in there for $100,000, because the capital represents the owner's worth in the business. If you notice, I'm not trying to get into debit and credit and double entry now, because I want you to understand. And these 3 categories of account, will make up the presentation. When we summarize, we'll make up the presentation on the balance sheet, or some call it statement of financial position. My training is in the US, so I use a lot of US terms, right? There are 2 general standards that govern accounting in the world. The US standard, GAAP, Generally Accepted Accounting Principles, and the international standard, IFRS, International Financial Reporting Standard. So you'll find that the world is becoming so fluid that these terms and so forth are used in between both standards. But you will hear me stressing most of the US standard. Number 4. So let me just say that these 3 here will be on the balance sheet. Number 4, we call revenue. We're in business to make money. We're in business to satisfy a very important accounting principle called, accounting standard called the going concern principle. Very important. We want the business to last forever, so people have confidence in the business and invest in the business. So we want to make revenue. Yes? Revenue is what we earn when we sell our goods and services. We will earn revenue. Okay? Revenue. When we sell our goods and services, whether we receive the cash right away or we sell it on credit, we earn revenue. And the 5th broad category, or maybe I should give an example of a revenue, right? You have sales revenue, professional fees, right? The 5th broad category of accounts, expenses. Expenses represent the amount of money you pay for items that you used up immediately in the business. So unlike a fixed asset that will be long term, An expense, for example, may be the stationery that you purchase, that you use right away for the running, the day-to-day running of the business. So you have, and you incur expenses. So these are terms that we'll use all along in our studies. You will incur expenses, right? And you earned revenue. So accounting has a specific language to it. You know, it's so nice. You know, I feel so good when I speak about accounting. So we will learn the language of accounting. So expenses are more or less spending to make sure the business is running. Revenue is what you earn to ensure that your business survives. And you want to earn more revenue than expenses. You an example of expense account, I just said stationery would be an example. Cleaning expense, another example. Salaries and wages, example. I give example of revenue accounts, right? But we are going to get into all of the detailed accounts for each area. Capital, just to review capital, the owner's worth in the business. Liabilities, what you owe to third parties, persons outside of the business. Assets, the resources in the business. Some are short-term, more long-term assets help you to make revenue because you want to have assets in the business to help you to make revenue. So our session today, where we zero in on the 5 categories of accounts: assets, liabilities, capital, revenue, expenses, is where all of your recording will take place. We'll explain to you how this recording will be done, debit and credit, which account will have those entries in another session. So as we close, I just want to say to all of my listeners, my subscribers, to hit that subscribe button, like the video, share it with friends, comment on it, let us know the areas that you want us to zero in on, because I'm taking this here systematically right through some progression so that you will be able to go to one video, then the other video, and the next video. So I just want to say once again, thank you for watching this video, for liking this video, for subscribing to this channel, and for commenting on this channel. Accounting Made Easy on the Whiteboard. See you in the next video.